Welcome to the Atomic Level, the show where we decode the matters of wealth, one insightful conversation at a time, with the rising stars in finance, business, and tech, so that you can grow and protect not only your net worth, but also your net happiness. I'm Chris Snook, and today I welcome a new friend, Nik Bhatia, and we're going to talk all about layered money strategies. But first, we're going to get into the man and what shaped his worldview. Nik, welcome to the show.
Chris, great to be here. Thank you for having me. Appreciate it a lot.
Awesome. Well, as the live stream fills up, please, guys, share the stack and let people know. You can ask questions. I'll try and weave them in as we have time. And if you're new or if you're listening to this on replay, you can always watch the video on all places that it gets distributed. But Substack is where we do the exclusive initial drops and the full write-up. So welcome to that. Please give Nik a subscribe along the way. He's going to earn it. I promise you. We'll do that again later. But I'm here to learn in real time with you. So as the recurring audience knows, Nik, I have no idea what you do except for you're doing it well. And we were talking about our friends over at MarketStack who kind of have created a really algorithmic way to identify who's gaining not only the trust and the attention, but in a sustainable way on Substack as more and more people put their attention and their intention-based search around financial related investment topics into this platform. There's a discovery mechanism that's kind of third party that we're a big supporter of with what they've been doing, just helping identify people like yourself. And so I kind of fish in that pond and find people to meet like you, and then do that meeting over these long form atomic level deep dives. And so we're going to unpack what it is you do, how you do it. But before we do that, who are we listening to and where did he come from? What shaped your worldview? So talk about us a little bit so we understand kind of where you've been and what got you where you are.
Sure. Thanks, Chris. So I am an independent researcher today as we sit here in 2026, and independent in every sense of the word. So I have my own research company. I'm an author of 2 books. I teach at University of Southern California, Marshall School of Business in the finance department. And so I'm employed by a university as an adjunct professor. And then I do have sponsors. I do ad reads on my YouTube channel, for example, and we throw some banner ads on our Substack as well. So I have sponsors and I'm employed by a university, but I am truly independent in every sense of the word, because when I say and when I write what I say and write, it is purely my opinion and not directed from any entity. So that's something that I've leaned into over the last several years since I went independent. That was in 2019. And it defines who I am. I'm able to then make predictions, make calls, explain when I'm wrong, explain why I believe I was wrong, where I could be wrong going forward, show you exactly the opposite view of my own to play devil's advocate and not feel like I have to dress anything up or down when I'm giving macroeconomic takes, financial markets, Bitcoin specific takes, or anything of the sort. So that's where I am and where I've been for approximately the last 7 years.
And so, you don't just land as a professor at USC, right? You don't just land with a Substack that is growing at a clip that is on both the bestseller list as well as the rising star list, kind of consistently in the top 100, which you've achieved. Where did you come from, and what led you to the path of first, being independent? I think it's great that you clarified that up front, because we all have biases. We all have things that we serve, whether they be brand partners that we use personally or whatever, but everyone kind of wants to know, who am I listening to and why? So, you clarified that up front. I think most of the people here on Substack are here writing and reading and listening simply because they're looking for that independent take, right? Let me make my own decision. And so that's one of the values right now at this stage in the subscriber model, at least. But where did you come from? Like, how did you get qualified to do what you do? And I say that with all the respect of, like, obviously you are, but what led you to that? Did you grow
Sure.
up around money? Did you grow up around technology? Did you not? Like, tell us a little bit of that backstory so we understand what got you interested in kind of in this world.
Absolutely. And it's important to clarify, that I am independent and that previously I was in the traditional financial world. So that shift around 2019 is something that it defines me today. But in terms of where I come from, my background, I've always loved global markets and thinking about how the world works. So that's probably my original motivation to get into this field. And then I went to USC for undergrad. I'm born and raised here in Los Angeles, California. And as I was studying at USC, I was between economics, general business, political science, international relations, kind of dancing around, seeing again how the world works, but experimenting with different aspects of it. And as a naive financial mind, meaning my family is doesn't come from finance, and my dad was a hobbyist in financial markets, but and a lot of my interest in some ways was inspired by his hobbyist approach to markets as a working professional, not in the financial field. So I had that inspiration, but in terms of having a mentor to help me get into big finance, I didn't have one. And so I was a little lost in my earliest part of the journey into how I wanted to enter this sphere. I didn't have this I didn't have the understanding that, you get an internship at a good shop right in college, and then that can lead to your first job. I didn't take that route. It was a little slower. When I ended up finishing SC, studying economics and political science, I was choosing between law and business, and I really wanted to study interest rates, currencies. That was my my genuine interest. And discovered basically this whole group of master's programs in Europe that would teach a master's in finance, 1 year concentrated program. Wasn't really available in the US at the time. Now, ironically, I teach one of the top master's in finance programs in the country at USC. Uh, I teach fixed income at USC as my standing course there. And the bond market is my expertise, my core expertise. The Studying finance, finally, I went to Madrid, Spain, IE Business School, got my master's in finance over there. And that was the year where it all came together for me in terms of what is the world of finance, even the simple understanding of the difference between investment bankers and asset managers, wealth managers, like all these different fields in finance. I said, I want to be on the buy side, asset management in the bond industry, specifically rates, US treasuries, and global macro focus. A very niche, uh, you know, uh, angle of the financial world, but it's what I loved the most. And so danced around a couple of jobs before I got one at a fixed income hedge fund in Southern California. And that's where I began my career. I began it as a true middle office guy. And for people in finance that would know, it means you're not in the front office making investment decisions, and you're not in the back as simply a paper pusher, but you're somewhere in the middle. You're interfacing with the desk and seeing really how the sausage is made. And that was a great way to start, a very humbling way to start, and worked my way up past CFAs level 1, 2, and 3.
Hmm.
Used that to my advantage. Got a job in the front office finally at a different shop, trading US treasuries on a trading desk at an asset manager with over 100 billion in management. So now we're getting into why I'm qualified to do what I do today and how I earned really the knowledge that goes with what I do today. It was being on a large asset manager's trading desk and being promoted from the lowly T-bills repo trader, someone who was trading overnight, 1 week and 1 month markets. My job was literally cash trader. So you're trading cash and cash like instruments for other cash and cash like instruments, wiring money in and out for clients. A very short-term rates, focused. And then within a couple years, I was the head of all US Treasuries trading on the security side. So non-derivatives US Treasury securities trading, as we call it, cash treasuries. I was the head cash treasuries trader in only a couple years. Now that's a combination of luck and skill, as any professional, as any promotion or series of promotions is. But right place, right time, intensely interested, cared, and I was good at it. I was good at trading front end treasuries. And so they gave me more and more responsibility. And I knew that I was made for that role because when there was let's say your favorite top 10 NASDAQ company, because we managed money for half of them, your favorite big tech company, they all of a sudden say, hey, here's $500 million and we're increasing our AUM with you guys by 500 million. Um, Come up with a strategy and have it all invested. Well, on day one, who gets the call? I get the call because, hey, go allocate 500 million in cash and treasuries, and then we'll buy the rest of the bonds later. Over the course of the next week or two, we'll trade those treasuries for bonds and credit and get our yield spreads and everything like that. But in the first 1 hour of trading, it's my job. And so I not only have to make the trades, but I have to make sure that duration, meaning my risk, my interest rate risk, is balanced across the curve. I'm doing exactly what the client needs. I'm also looking at the market and saying, you know, understanding the difference right now in this moment between 3-month bills, 6-month bills, 2-year notes, 3-year notes, and 5-year notes. Like, where do I want to keep the cash based on my mandate and based on where the market is, based on where the Fed is? That experience, being in that seat, is everything to me today. When I draw on my time there, everything I learned about how it works at the top, at the and I'll just throw out the names. I'm talking about Apple, Boeing, the state of California, the New York hospital systems. I'm at University of Michigan, Arizona State. I'm managing their cash portfolio more than anybody else in my firm because it's their safe sleep. So they're not yes, they have some risk at the margin, and that's my boss's job to understand how much risk. But in the core cash safety realm, that's all my job. And yes, I work on a team, but being there in the middle of money market funds, huge corporate clients, the Fed, the Treasury Department, and then the sell side Wall Street, which is all the broker dealers that show up to the Treasury auctions themselves. We're talking about Citi and Goldman and JP Morgan and Bank of America. It was Merrill when I started. The broker code was still ML, you know, uh, when I was trading back then. That is how I learned what I learned. It's being right there at the middle.
So it's a great context, and not knowing that, I'm really glad that you gave us that context, because it takes my line of questions in a whole different direction. To lighten it up a little bit, because no one under 14, I don't think, listens to this show. So, and if they do, I apologize to your parents for using this analogy or metaphor. But when did you find out that Santa Claus wasn't real through that lens, and what was that moment?
Yes. It was before I started my career, and that's me being very honest. So the timeline there is that I got my first job in finance in 2013, and the financial crisis of 2007, 8, and 9. Uh, I was a college student, and so my intellectual curiosity about bank bailouts is the foundation to me getting involved in Bitcoin many years later, but me getting involved in gold and silver before I was even a financial professional. And that is the God's honest truth. I saw that Santa Claus wasn't real when I asked myself, what is QE? And then I went for the answer, and I went all the way. And I will credit, in this moment, I will credit zerohedge.com for those that
Yeah.
have been around a while. There's probably very few of you out there that were going to that website when it was zerohedge.blogspot.com. And I was one of them. And so that's how I know a true OG in the online Austrian economics world. But yes, I was reading Zero Hedge when it was zerohedge.blogspot.com. And the reason I was doing that is because nobody else was writing about how the Treasury would auction these bonds, the primary dealers would buy them, and then the primary dealers within 2 weeks would go and post those individual QSIPs, which is what we call a ticker in the bond market, post those QSIPs to the Fed, put them up for POMO, which is the permanent open market operation that they had every single day in the market buying treasuries, their big QE program, the original QE program. And that 2 week lag between treasury auction and the dealer selling it back to the Fed, that was the most blatant workaround of debt monetization that I had ever seen. And I was brand new. I was really green. So I didn't understand what I was looking at. But what I knew in my heart was that they were they were putting makeup, putting lipstick on a pig, or they were dressing something up and then looking at you and lying to your face. And and then QE is its own thing, Chris, but what about the $900 billion bailout for Citi? I remember they called him Pandit the Bandit, Vikram Pandit. He was the CEO of Citi at the time. And then the AIG bailout, which was in the intense moment of
Hmm.
the Lehman collapse, but the AIG moment where you understood that actually Goldman and Morgan completely go away if it wasn't for AIG getting the bailout and making the investment banks whole on the insurance on the CDS that they were underwriting for the clients, which all, by the way, it all went bust. So they had to pay out on the CDS, and that's why they had to go to AIG. That was their hedge, and AIG got the eventual bailout from the government, from the U.S. government. And so the
I
bank
always wondered
bailouts,
why. I always wondered why a meme has never surfaced around, that locked door meeting at the Fed where they were all sitting around there discussing TARP and doing whatever right before it was the thing. And there's not a meme of like a mafia scene where you have like the five families and everybody's got guns at each other's heads, because that was kind of the reality. Like it didn't have to go the way it did, but when it started to go the way it did, then it was like, okay, um, it's either all of us or one of us, but
yeah.
what are we going to do here?
And I just and real quickly, I just watched The Big Short for
Oh, 15th time,
for
20th
the
time, like
umpteenth
me.
time.
Yeah.
I showed my summer students. We can get into that. I have a new summer course at USC where I'm teaching high schoolers. It's absolutely brilliant.
Oh, that's awesome.
I showed them The Big Short on the last day because you keep it light. They're on summer camp,
Keep
and
it light.
yeah, and I'm watching that. I'm watching that movie and just loving every moment again and again. But that scene at the end where Mark Baum, the character played by Steve Carell, he says Paulson and Bernanke just left the White House. Let's close the position. And so,
Right.
he was the one who held all the way to the end. But then, yes, when you see the writing on the wall, then you do have to exit because they're going to come in. And it was one of those foundational periods in my life where I was already in a young person, anti-establishment, that phase in your life, and then you get the largest set of bank bailouts in the history of the world, coupled with the largest quantitative easing program that the planet has ever seen, and all of this stuff. And I'm looking at the system thinking, is this just? Is this fair? Is this right? And as a college student, you don't need much more than that to have a foundation as to who you are and what you think. And so fast forward to when I found out that Satoshi Nakamoto put Chancellor on brink of second bailout in the Genesis block, and that he or they were inspired by bank bailouts to create a currency system that was immune to currency dilution, you can see how that really clicked for me as someone who was originally inspired by bank bailouts to be aware and you know, knowledgeable about how, like you said, how Santa isn't real.
So I think, in and I say this because I'm curious about where you sit and how you reconcile and balance these things tactically and pragmatically today. We'll get into the frameworks. I want to talk about layered money, which was the name of the book I think that you wrote, and it's also part of your Substack strategy. I want to understand what that framework is. Um, it sounds like what you did was you decided to go inside the beast, right? Because you recognize I can understand it from the outside, or I can get inside of it. You got inside of it, and you actually saw what cash management looked like on the inside, 500 million at a clip. That's a lesson that no one really gets. Very few people get that lesson. Um, and then you chose to do whatever you've done with it. We'll get into that over the next hour because some people stay in, right? Because they decide, you know what, like I may not love the game, but don't hate the player, hate the game, right? Like I'd rather be on the winning team. That's what a lot of people do. They go in with the right intentions. They go in to disrupt. They go in with idealism, and then they get handcuffed in a way that is hard to leave. And then there's people who stay on the outside and they run around and they're the pirates and they fight the good fight, but usually they end up in dead, jail, or broke. Um, right. And sometimes they're martyred. Once in a lifetime, once in a humanitarian thing, you get a Satoshi Nakamoto, whoever they may be, whatever they may have been. And again, without it being a bias one way or the other, how do you reconcile the idealism with the pragmatism of markets today? Because one of my favorite conversations in 2012 was with G. Edward Griffin. Many of the people listening to this probably know who he is. Some who don't. But The Creature from Jekyll Island was a book that really changed me back in the late 90s. And I had the chance to put him in a car and take him to a show I was producing in 2012 down in L.A. During Occupy Wall Street, and I spent 90 minutes with him. And he wasn't a conspiracy theorist. He was one of the smartest. Like, he was just an awesome dude. I was like kind of shocked, actually. Like, he was just very sensible. But I remember during that car ride conversation just feeling like here's a guy who really kind of understands how the sausage is made, right? The current monetary system. And so if we look at the world as it was, we've had several of these central bank monetary systems in the US. The most recent one's 113 years old ish. So it's what most of us, and it's all we know. And everybody knows fiat always goes to zero. It gets repriced however it gets repriced. Everyone knows the hegemonic kind of statute is where it is, right? Between the dollar denominated debt and the petrodollar and all this stuff that you can talk about bricks all you want, but the reality of that becoming real is less. We can idealize Bitcoin as a better way. The reality of it holding the global economy today, not yet, maybe ever. Doesn't mean it's not a good investment. Gold, silver, same thing. Doesn't mean it's not a good hedge. Doesn't mean you shouldn't own some. Just means probably not going back to that. What do you do to reconcile and teach the pragmatism, invest the pragmatism, and also arbitrage the asymmetry of something like Bitcoin or gold and silver?
Wow, Chris, what a great question. You really, zooming all the way out there and getting into what we do at the Bitcoin layer, because I think, first of all, I think you and I are aligned on a few things here. Especially, I love the fact that you already mentioned and then dismissed bricks within a few seconds, because that is a lot of what I do too. I'm in the I'm in the please dismiss bricks approach to global financial markets. And by the way, I've been doing that for a decade or more. Even though I saw it rising, I saw the dollar system continuing to emerge as the final boss here. So I really like that you said that. And
Well, and I want
you
to
have,
be clear. I'm
yeah,
saying dismiss bricks because I'm inviting someone to give me a reason to believe it.
yeah,
Similar with the yen, right? Like, so again, same thing. I've learned one thing. that being early sucks. I've been early a lot. I've been right a lot, sometimes too early. And, being convicted and convinced of something is good until it's not good. So again, I'm inviting the debate, but I just don't see the argument there. I do think the plumbing's been changed. I think the flows have changed, and I don't think people have fully reconciled that yet. I don't know which way that goes, so I'm curious as to your take. So to give you more context on that, like, I'm happy to be debated. I am happy to learn. I want you to break some of my paradigms, including the ones around Bitcoin. I mean, Michael Green had on the other day. He said Bitcoin's a boring conversation. I'm kind of done with it. I moved right on. Not going to fight the guest. I'm here to learn with my audience from people like you. So take it from there. But yeah, so you're not a big believer in bricks, but let's talk about the rest of that conversation.
Yeah, it's not that I'm not a believer in bricks. It's that the idea that a bricks currency or a gold-backed Chinese currency is the replacement and therefore the reason to dump the dollar. It's overly simplistic. It doesn't factor in how multifactorial the system is. It doesn't mean that China isn't rising. Actually, China is rising, and China's rise needs to be understood and internalized, but also in the context of the dollar. So you say that, yeah,
I
yeah,
agree with you there. I'm going to give you one more thread to pull on,
sure.
just as it relates to some of the stuff that I've written about. Again, happy to be debated on. I've called the dollar the source code, right? So like I come from the technology lens as much as the financial lens. So when you think about source code, like, it's kind of like the operating system. So if the dollar is the operating system for the global economy, well, there's application layers on top of it. And there's all this systemic flow between these code lines, right? And so it's pretty hard to rip out source code. It's like what G. Edward Griffin said to me in the car. He's like, you're trying to take the Federal Reserve and the Fed, Ron Paul. I'm a big Ron Paul guy personally. That's my idealism. I love Ron Paul. But, it doesn't matter if I voted for him or not. He wasn't getting elected, right? And you weren't going to end the Fed. And G. Edward Griffin's version of that was, you can't cut a 400-pound tumor out of 500-pound man and not kill him, because there's blood vessels, there's lymph nodes, there's all this stuff running through that tumor. So even though it's cancerous, it's the majority of the body. And I would use that analogy to metaphorically say, if the current system we have is the metaphor of a 400-pound tumor and a 500-pound man or woman, you don't have to like it. You can call it what it is. You can call it cancer, but you can't eliminate it tomorrow without killing the entire body. And that body is the global economy in the real world and in the financial world that everyone's future is bet on. So
Yes, it is the credit system and the way that money comes into existence today and the way it flows around the world that is dollar credit based. And so if you if you break that system up, you essentially cut off the flow of the global economy. And that's what you're saying is you can't actually remove that. So I like the idea that the dollar is the source code. I call it, in my second book I wrote about this, Bitcoin Age. I call it the the global dollar system is deeply embedded into the global economy, specifically the credit creation mechanism. That is done through dollar capital markets and through dollar banking. And the fact that the world, meaning you, me, everyone that's watching the show, when we get paid, when we receive payment for our labor and services, we accept dollar deposits, whether it's a check, a direct deposit, a wire, whatever it is. That is a payment from their banking liability account, a deposit into ours. And the fact that we accept it is the proof that it's the dollar deposit layer that allows the global economy to function. And so if you remove the credit creation mechanism that allows deposits to come into existence, what are you doing to the system? You're removing all of its organs, to use, continue your analogy. So the dollar system, it's not only the dominant currency, but the dollar system itself, by which credit is created and deposits come into existence that allow deposits to flow on the other side of economic activity. That's something it's foundational. Now, you mentioned a couple things I want to hit real quick. You mentioned Occupy Wall Street. Well, I want to give a mention to a book, David Graeber, and Graeber was the one
Mhm.
who was involved in this movement at the beginning. His book on debt, 5,000 Years, that book changed my
Unbelievable book. That's an
un-
unbelievable book. Yeah.
unbelievable book. And in the end, I actually disagree with a fair amount of his conclusions, but it doesn't change the fact that anthropologically, what he discovered and explained is it should, I believe, alter people's worldview, those that are anchored in this idea that we need commodity money to allow for an economy. Actually, it's the IOU, it's the whole, I would say, our human our human gravity towards accepting IOUs is is very anthropological, and it makes sense then why we're all circulating deposits and not gold, and the global economy is functioning at an incredibly high velocity. It's because credits are okay to make an economy work. It doesn't mean that you want to store your wealth in credits. In fact, it's a very old American wealth building approach to want to buy real estate with your hard-earned earnings. I always like the Tony Soprano line, "Buy land, God ain't making any more of it." Obviously, he's taking an older saying, but that whole thing of God ain't making any more of land. So if you earn in deposits, buy the land because the deposits are being created. That's not a new concept. People understand that, and they understand buy stocks and hold them over the long term. Buffett has tried to teach the American public about this for 40 plus years. And so the dollar system being dilutive, and like you say, all fiat systems going to zero, it's not a reason to remove it entirely. And in fact, when you look empirically, the likelihood of something like that happening is very low. So then the question to you becomes, okay, well, how do you survive in that world? How do you invest? How do you protect your wealth? And that's what you and I are doing for our audience.
Yeah, I think, I wanna say it was Gestalt theory. I can't remember if that's how you pronounce it or not, but it was out of Europe back in the late 1800s, and the theory was tested in paper money, with essentially a couponing, and it was around separating currency and money from each other, right? We've combined those 2. We've merged those 2. Most people think money is the dollars in their bank account or the cash in their wallet. That's actually currency, right? It's tokenized debt in a paper form or in a digital ones and zeros on a ledger that takes 5 days to settle. That's the current system. Um, it's not money, it's currency. It's a promise. It's an IOU. It's somebody else's liability. So when you think about commodity money and you go, okay, well, why is that money? Well, because it's nobody else's IOU. The gold is the gold. There's no IOU on the other side of it. So it serves a different utility and it can be used as currency. Bitcoin can be currency. It can also be money. Pick your favorite crypto, but just keeping it to the Bitcoin kind of standard. The point is do we need a world where we have money and currency separated? And what does that world look like? Is there a layered strategy in that? Is that part of what you promote? I don't know. If so, how does that play out when humans are no longer the biggest economic engine of the economy, which is where we're heading, right? Because we're talking about this through the lens of history and through the lens of our current awareness, and we're 8.2 billion strong, buying stuff. But we're going to be outnumbered 100 to 1 inside of a couple of years by agentic AIs that don't buy on the same emotion justified logic patterns that we do. And they're not going to buy on banking hours. And so the question then becomes, what role does that IOU economy, do the stablecoin rails and that hegemonic dominance in that world play when a fully tokenized digital economy is the majority or the next doubling of our current global economy? Doesn't mean humans go away. It means that we will never outspend trillions of agents that are transacting on our behalf in micropayments 24/7, 365 at light speed and permissionless or with permissions. And so when we think about that, who wins that game? How do you invest in that game? What does the real human economy look like inside of this parallel agentic economy that's going to be expansive? And
The
where does the debt market play into that in your mind?
Yeah, these are also great questions. There's been a great early study now published by Bitcoin Policy Institute, which I'm a visiting fellow at. They published something very interesting this year, which is they asked different AI agents which currency that they prefer to use, and the conclusion is really interesting here. There was a obvious bias toward digital currency, but then within the digital currency, it was a split really between stablecoins and Bitcoin. And the reason that there's a split is because of what I'm describing and what you're describing with the difference of currency and money is that currency is needed, or we need extensible quantity of currency as human beings.
Mhm.
And then we use money to protect, wealth that we've earned over time, and also as a way to go in and out of other assets. We can use currency to do that, but we think about money as a form of an asset, a long-term asset. So how does the AI economy change what we're working with here? I think it accelerates stablecoin adoption and allowing the current form of the dollar to go from a banking dollar to more of a sovereign debt secured dollar, which is what stable coins really are. This weakens the banking system at the margin and the banking system's ability to flood the market with currency, as you suggested. But then on the other side of that, it empowers the government, the sovereign debt issuer, to borrow more because the debt is essentially being demanded by AI. And that itself is very interesting to me. It is part of the paper I wrote for Bitcoin Policy Institute, which is that demand for stable coins by itself, whether it's AI related or not, demand for stable coins is evidence of demand for the dollar. And that all works to the United States government's favor because it empowers the sovereign debt issuance at the margin where it might not have had that
You
additional
know,
demand.
it's as we have this conversation, there's a bunch of questions. I'm publishing a long report around this, the first part of which the first 10,000 words will be free. So I'm not here to shill anything. I'm doing it as a thought exercise for myself related to this endless scientific, rebirth that we're now entering as of 2 days ago with the publishing of the 123-page report that many people may or may not have seen, but that I'll read and write my breakdown for so that you have a reason to go look at it yourself. But it relates about this reinvigoration of science in the U.S. as a key critical driver, right? The Genesis mission, all these things roll up into that. When I think about stablecoins and I think about what just happened with Moonshot, right? Because Kimmy K3 comes out and kicks Fable's ass, right? For a third the price and open source. And China's doing what China always does, but they're smart because they own more nuclear power. They own the supply chain still. You can't get chips without that little island in Taiwan that they could invade at any moment and cause problems. And so they don't really care about the frontier models. They'll give them away because we're the ones spending all that money to deliver the frontier models, and then they can go knock it off with an open source thing. And programmers and people that want to be sovereign and free want open source, right? We don't want to be closed and trapped. But the economics now of an Anthropic or of even a SpaceX and XAI included in that, and any of these top 4 to 5 IPOs or Mag 7s are too big to fail. And they're also national security risks. So if I'm thinking out long, and I'm speculating here, but I'm curious if you thought about this, like you China tried to ban Bitcoin, and obviously they did it for currency flight, and they've done it 100 times, and it didn't work, but it did work. And they can do with that. They can do those things. The US comes out and says basically, moonshot, no bueno, like we're gonna go all in. And now there's regulatory capture essentially by our frontier AIs. And it's through the name. Besson just came out yesterday or today, I think, and basically said, like, you're not going to be able to use K3. Like, it doesn't matter. So we're going to put $100 billion behind making sure that no matter what Anthropic and OpenAI and those guys need, they're going to get. So that's regulatory capture. There's no other way to look at it. Now, it could be in the best interest, but it's still regulatory capture. And so when I think about stables and I go, okay, so that's a smart move. That's the way we can ensure not only the U.S. Treasury markets and things like that have a new buyer as maybe foreign holders diminish their holdings. But the real play is on being able to create a sanction type rail system for token economy, because I could make the stables the on-ramp to your Anthropic tokens. And then where does Bitcoin land? Maybe Bitcoin becomes the only collateral and the only currency that an open source competitor like Kimi K3 can use. But then what is the U.S. position on that? Well, if we hold some Bitcoin in a strategic reserve, we have power projection protocol, we can attack that network. So there's like all these things that I just am fascinated by how they play out. None of them lead me to these things go to zero. And I'm not here making a shill for go buy Bitcoin. I'm saying it's 66,000 or whatever the hell it is today in the currency swap of USD. If it doesn't go to zero, it doesn't stay here. And you don't have to be that big of a genius to realize that the asymmetric upside of it getting on par with gold as market cap means there's a lot of ROI to hold between here and there if you just believe that bots are going to buy more than humans.
Yeah, so if I can summarize a few things quickly here. Layered Money, the title of my first book, which I published in 2021, and the Bitcoin Layer, which is the name of this Substack. My Substack is a derivative of Layered Money. The framework is based in Perry Merling's inherent hierarchy of money. It's a hierarchy of balance sheets and financial instruments. And this means that a gold coin is the asset of the issuer of a gold certificate, and the gold certificate is the asset to a bank that is issuing a deposit or currency in some way that promises to pay the gold certificate. So money is layered, and it's layered because there is a hierarchy of balance sheets and a hierarchy of financial instruments within that hierarchy of balance sheets. It's a concept that is almost commonplace today to think about how your deposit is the liability of a bank and the bank owns treasuries or reserves at the Fed on the other side. And even going back to when we had a gold standard pre-1971 and where the currency, the paper currency actually said gold, gold certificate or pay the bearer gold coin on demand, for example. So we're familiar with this hierarchy concept, but as it applies to Bitcoin, I believe the reason that I wrote Layered Money was to explain to people Bitcoin is more like gold than PayPal. Here's the balance sheet framework to explain that to you and to show you Bitcoin is not PayPal. You might want to compare it to PayPal, but from a balance sheet perspective, it is not PayPal. There is no issuer. There is no layering of liabilities whatsoever. It's only comparable to gold in that gold is a commodity money. It's not issued by anybody, and in Bitcoin isn't issued by anybody but the protocol. Just like gold isn't issued by anybody but Mother Earth. It's like they're more metaphorical descriptions of where these things come from. So that's what layered money is. And so that is the basis that I use to explain to people that in a world of fiat, in a world of credit issuance, dollar dilution, and going back thousands of years looking at currency dilution, the way to protect yourself is with assets. So that includes gold, Bitcoin, stocks, and real estate. So then that brings us to today, where now I try to explain to people, well, if you want a balance between these assets, what is the right balance and how do you approach it? Now, you'll notice that US treasuries are not in the conversation of assets that you should own to protect yourself because they themselves get diluted over time with negative real rates looking backwards. Today, I know real rates are actually at multi-decade highs in the United States, with the inflation rate being, more than 2% below where the 10-year yield is, for example. But the US Treasury is not an asset to own because it is it has negative real interest rates looking backward. So if that's not an asset to own, then what are the assets to own? And this is where I'll bring in full circle. You said, how do you balance the idealism with the pragmatism? Well, if you believe that the United States, and this is the big part of my thesis here, if you believe that the United States itself is losing, that means that the United States Treasury prices are collapsing to the point where the rate needs to go up so high to attract the marginal buyer. If that is your belief, then how will United States stocks be able to sustain their current present values if, you know, bond yields are all rising? You're basically slashing your present value calculation every time rates go up. But now you actually look at what has happened empirically. Treasury rates have gone from 1% to 5% over the last 5 years, and stocks have doubled, tripled, and quadrupled. So, why? You have to ask yourself why. Why do stocks keep going up if the US Treasury market appears to be crashing in slow motion? And that's more of an open ended question than anything I have some authoritative answer to today. But that's how you balance the idealism with the pragmatism. Is you have to look at what you thought would have happened if rates went from 1 to 5% to stocks, and then look at what stocks actually did and understand that your linear thinking of a treasury slow motion crash will cause other asset prices to decline, that's wrong. And so why is it wrong? Well, the last thing I'll say here is that we're probably entering or have entered an entire new economic era that is not a liberalism free trade world. We're in an economic statecraft world. This is a world where the Fed might take stakes in Anthropic and OpenAI. OpenAI might literally gift 5% of its company to the US government. Who has ever heard of something like this? This is a very
Well,
unique
and
time.
you blend in the Trump accounts vehicle, which would then have another vehicle that benefits from a gift such as that, or other gifts like it from other important companies, let's say. And at that point, you kind of wonder, how does that change this market that we think is a free market, but that I would argue has not been a free market since 113 years ago, but that looks like one still, right? Um, and does it even matter, right? And again, like if we just got unreligious about it and we just thought purely practical, does it matter? And it only matters if you're on the wrong side of it.
I
And
think that's
I'm not saying that because I don't have an opinion that I want to see happen. I'm saying that because that's the practical question that needs to be asked.
Yeah, I think that's part of my approach and why I write the way I write and all that. You can, you know, have your opinions, biases, but in the end, we have to operate as investors in the real world. Now, what that means is that I've chosen a path that maybe other people will label as you're not revolutionary enough, or you're not fighting the good fight, or you're not sticking up for, the little guy because you are apologetic for the credit system existing. If that's how the outside world wants to describe what I'm doing, okay, I'll accept that critique because I'm not trying to get you to put your whole uh, economic standard on Bitcoin, because That's not practical for most people. If they put all of their salary into Bitcoin, well, what do you do during 60% bear markets if you have expenses? You might go bankrupt. So I can't suggest for people to do that. I want them to find the middle ground between understanding history, making a projection about where asset prices might go in the future, and then also just being able to generate dollar income, because the reality is our expenses are dollar based. So if you can secure a large income stream in dollars, then why would you not do that? Why would you not do that? And Bitcoin doesn't provide uh dollar income streams in its current form. That's why one of the things we're doing is we're showing people, hey, if you have a Bitcoin ETF position, here's how you might want to underwrite some options on your Bitcoin position to actually generate income from it. But in that way, you are exposing yourself to having less Bitcoin. You're also essentially forcing yourself, if you're on US soil, you're forcing yourself out of self custody Bitcoin into third party Bitcoin, which is an explicit move down the layered hierarchy of money when you start to accept a claim instead of that counterparty free money, which is physical gold or Bitcoin held in self custody. So we all have to find that balance. And I, 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 I have the radical inside, Chris, but I have to be a pragmatist because I have thousands of readers around the globe now. And I also have students that come into my classroom either from their teenage years to their mid 20s. I have to teach these young people how to go out in the world. So, can I, in good conscience, tell them, hey, turn all of your salary into Bitcoin because the system is rigged against you? That's not practical. Actually, I mean, you go into a college classroom and try to teach people that. Actually, your students will call you out on your bullshit. And so
Well,
you
I
really.
think a lot of the you would know because you have the front row seat. I taught a class a couple years back at the University of Wyoming. I was doing a bunch of work up there when they were doing all their regulatory stuff with their digital asset laws and things like that. And I taught it was in the business school, but it was multi campus, like it was a cross pollination, and it was a kind of a work study elective course. I taught it with a guy named Corey Billington, who was the actual faculty member, and I remember being a little bit less shocked. Like I thought that the student body, and this was 2022 through 23, maybe 24, somewhere in there. I thought the student body would be a little bit more skeptical or nihilistic than they were, and meaning like, oh, it's a rigged game, so I don't care. Like, and they weren't. They were curious. They were all the things I was hoping, but they were less skeptical and nihilistic. They were hungry for truth, whatever we think that means. They certainly weren't going to tolerate anything but authenticity, so I'm sure you've recognized that. And I felt a lot of hope, actually, more than I thought, interfacing with those handful of dozen young adults, because they hadn't made up their mind yet. They had ideas, but they were still open to they just wanted to be opened up. It really excites me that a program like this exists at USC, because I think a lot of college universities have failed to kind of deliver against some of these things that you're teaching in recent years. But you're proving that that's not 100% the case if you're teaching a course like this at USC, right? So I think there's a lot of FUD out there related to that too. What what's your advice to the person who wants to talk to an advisor? Because a lot of my audience, is wealthy enough where they've got something to lose, but maybe it's 2 to 5 million, and they earned it on, being prudent and also just well timed in this last 15-20 year ride. And so they're looking at transferring it. They're looking at holding on to it. They're looking at living longer and all the expenses that come with that. Um, but they're not necessarily sophisticated. They're maybe here because they're trying to learn what they should be asking their advisor. Maybe their advisor is not just retired on site. hoping they don't call them. Maybe they're active. That's usually the advisors that listen to my show. What's the conversations that you think they should start having around the 60/40 portfolio, around alts, around like just practical stuff? Like how does layered money factor in or empower them to have more powerful conversations with the client or with the advisor?
Yeah, and I just want to address Tom's point. He's saying that you can't teach something. I can't not teach something because someone will call it out. It's not. Maybe I misspoke. I don't believe that they should be doing that, and I'm not doing it myself, and so I can't teach them that because I don't believe that they should be doing that. I I tell them actually. I think you should have an unreasonably large allocation to Bitcoin as a young person, but unreasonable versus what you might think today, not 100% and not all in, and not necessarily even all in mentally on your career, because then you might avoid traditional finance altogether because you think it's it's BS compared to Bitcoin, and so that's not a good approach. I learned most of what I learned in the traditional seat as well, and I actually want them to have that same experience if they can, go out and work in traditional finance if you can. So,
Yeah, and
listen,
I
yeah.
appreciate that. I think that's a good point to clarify is you're just teaching what you would do, and you're not saying it's right or not. You're saying it's right for me, and here's what I would do. I can't teach you to do something I'm not gonna do because that would be false or fake or misleading or any number of things, right? Irresponsible. Um, so it's not about saying what they wanna hear. It's just basically I can only teach you what I'm doing. I could tell everybody here my own thing on that too is I am trying to constantly convince myself why I don't want to own more Bitcoin. I'm always trying to do it. If you've read my stuff, you'll think I'm trying to sell you Bitcoin, right? No, I'm trying to convince myself why I don't want to own some. And it doesn't mean I don't want to have bonds. It means I know I'm lopsided, right? I'm way over indexed in asset classes that I understand, right? Startups, ventures, early stage stuff. I'm way over, like I'm stupidly over indexed at 50 years old there. I have to find a way back to some of this other, boring, risky stuff, right? So I'm here to learn from you and others on those asset classes because I don't have allocations that I want to have there. And I think a prudent investor is just going, okay, I'm tired of hearing it's rat poison, or I'm tired of hearing it's the savior of all humanity. What the hell does it actually do? Why do I help me understand who might use it? And if humans aren't going to use it and bots are, well, that's still a market. And if a human can own it today and doesn't have to ask anybody's permission to go buy some, well, then maybe I should probably get some. How do I do that? Oh, I buy IBIT? No, no, no. That's not the thing. That's the paper representation of the thing. If you want price action, yes. But if you want the actual thing, you have to learn about what that thing is and where to go buy it. You should probably do that. Then you can decide. I think that's what we're all here to do is look at that asset, whether it's gold or ammo or seeds or whatever the hell, right?
Yes. And I
So
and real quickly, Chris, I wanna specify that I teach 2 classes at USC. I teach grad students, these are Masters in Finance and MBA students, and the course is called Applied Finance in Fixed Income Securities. I teach the bond market, rates, global macro, monetary history, the dollar credit system. Bitcoin literally is not mentioned in that class. I keep it out. It's a fixed income class. They wanna watch my stuff after or ask me a question after class on Bitcoin. Maybe at one point throughout the semester, I might answer a question or two, but it's not a Bitcoin class. It's a US Treasuries class and a global macroeconomic class and a monetary science class. Then I teach a new class. I've just completed the second version of it. It's called Bitcoin and AI, the future of finance and technology. It's a high school summer camp, 4-week intensive program. The students come to USC and they choose one class. And I had 34 students this summer, and they come in and they learn Bitcoin and AI from the context of finance. So I teach them corporate finance 101. I teach them AI. We teach them how to use AI tools. I teach them about Bitcoin. Teach them the software. I make them download a wallet, and I give them their first few thousand sats each. And we transact in Bitcoin. We look at transactions being confirmed on the blockchain. They have to send and receive transactions. They have to note down the block height. And then they use Lightning Network, which is a second layer technology using Bitcoin to compare using Bitcoin's blockchain versus using Bitcoin on a lighter second layer transaction network. So I like to teach practical things, and I have a very different I have two very different classes
Well,
in
so
the
I want to shift gears because I want to get into your bond stuff because the bond market's exponentially larger than the equities market, certainly blows away the size of the Bitcoin market. Um, I want to get into that because I'm actually curious in your thoughts on emerging market bond portfolios. I've had several guests on over the last month or so with different perspectives on that. Gunlock just had a big, interview the other day that's got half my family office friends all freaking out because we're 50-50. We don't know which way are they going up or are they going down? What's the long duration bond market going to do? Is it 6.5 or is it going to crash down to 2-3, right? Like where is it heading? And then and I don't have an answer. Then I talk with guys like Mr. Tix, Martin Tixler, Tixier, sorry, Martin Tixier. Give him a shout out. He was an interview maybe a month or so ago. A long-term bond market guy was talking to me about, I think, Kazakhstan and basically like, a double A rated, 10.5 interest rate on something that's, a double to triple where you are on a US Treasury with relatively related risk. And I'm going, well, that's interesting. And again, so what do you look at when you think about fixed income and retirement portfolios and just capital preservation? What what is the contrarian view there on bond markets, or what is the consensus view that you endorse? I don't care which one it is. I'm just curious, how do you look at that, and where does emerging market debt play into the mix?
Sure. I'll start by saying that I cannot give you an educated opinion on emerging market debt for two reasons. One, it's not an asset class that I follow closely, but two, emerging market debt, especially in currency terms that are local, it's not just the debt. You have the central bank and the government's willingness to monetize that debt either through the central bank or the government itself. So the yield on emerging market bonds is going to be representative of the country risk, but also the investment opportunity is is also dependent on the willingness of the policymakers to support that market. And so that's why I can't have, and if I did, I would tell you these are the countries that I understand the sovereign bond market better in, such as Germany, Italy, and France. I understand the sovereign market bond market a little bit better in those countries, especially in the terms that they are euro denominated and that the countries by themselves can't do anything to bail themselves out because the monetary authority is in Frankfurt and not part of their realm. And then to a lesser extent, Japan and Japan's sovereign bond market, which is its own study and something that I'm studying a lot. So
Yeah, so then let's shift gears into that then. So talk to us about, because I see some smart minds in here. So guys, if you're in here, whether it's in the comments, I mean, I know you have takes on this. I see Hugh Hendry in here, which is uh, amazing. You got Hugh to jump in. That's awesome. I see George Noble, Damien Shat. I see some people in here that have significant thoughts and following. Stacey Taylor, you're back. I just want to give a couple shout outs into the live chat. I'm not picking on anybody or leaving anybody out, but feel free to throw some comments in here on some takes that you have. I I want to understand, kind of from your lens, the carry trade, the dynamics there in flux, the currency swap. I saw Hugh talking about the other day, yen 250. Um, for the layperson, for the college student, for the average, person who's just trying to make sense of it all, which is all of us, right? That aren't as smart as you and haven't had the exposure in the bond markets that you. What's your take on these things? How worried should we be or not? Do you have an opinion on the long end of where yields go? Um, all those, any and all that.
Yeah, let's start in Japan and then we'll go to back to the US. So on the Japan side, the sovereign bond market, JGBs, the yield could rise and it could rise materially, but the yield rising there is a capital loss to the populace. And so they will be biased to hit the currency instead of the bond market. That's my fundamental understanding there, and so that's why the yen is in danger. And this 250 call, it's not a new one. It's been around since really I started trading the markets, and I thought I looked at the math and I said, oh well, there's all this sovereign debt. In the end, they're going to have to monetize it. They're going to have to print yen to do that. So I
So
think
they're facing a choice of debase or decapitalize, and in layman's terms, and if they can pull one of those levers instead of both, because they might have to pull both, but if they can pull one, the one that they'll probably choose is debase because the impacts are less felt, right? The inflation.
right, and Japanese government bonds are held internally. So, as long as these things are being held internally, then rising yields in Japan hurt a lot to Japanese investors, Japanese retirees. So, and in the United States, there is a significant amount of debt held outside the United States, more so than Japan. So that does affect that relationship in terms of U.S. yields and where they could go, or the potential for that to be a good investment for retirees. It's a very dangerous instrument to own, especially if you're using long-term debt as your proxy there, or the asset that you're trying to pick up a few extra basis points so you go out another 20 years on the curve. That can be very dangerous because in bond math, the longer the bond, the more exposure you have to price depreciation when interest rate rise. So a simple 1% increase in bond yields in the long end could wipe out a dozen years of income or a decade of income. So a very dangerous asset to own. If
So,
yeah,
and again, I this is why I want to pick your brain on this. So in that scenario, if that is true, let's just say that's true. I'm going to take your word for that. If that is true, but what's also true right now is we have more on the front end, and on the very, very front end, like we have more dollars where it's almost a freaking casino. Um, h- how does that play out? Because if the incentive to own longer duration is dangerous, and I could say I agree with you, I'm going to take your word for it and make my own decision now and say I agree with you, then what happens? Because the front end can't really hold much more, can it, without something else breaking, or can it?
the quantity of money that there is in the world on the other side of the supply of short-term treasuries, I think is still quite balanced, meaning that if the US Treasury, and we know this going back to the Yellen days, Yellen and to Besant, the willingness to increase the size of the 30-year auctions is essentially nil. They don't have any capacity to increase the supply out there, because if they did, they're worried about what they would do. So they keep continuing to increase the supply on the front end. So what is the result there? You actually have a yield curve flattening, which is the relative demand for the long end is going up to the short end. Yields are compressing. The curve has flattened a lot this year. It means that the pickup that you get for buying 10-year notes is minimal relative to 2-year notes. And that is evidence of demand for safe assets.
Right.
And it's also evidence that there's not too much supply. And so as the United States yield curve continues to show any sort of flatness, it's telling you that the US is doing a good job of not issuing too much out the curve. And then your question is, well, what about the quantity of supply in the front end of the curve? Well, I would flip that around to you and say that there's $350 trillion in debt by the IIF's measure that they release once a quarter or so. And so if you talk about the amount of marketable US Treasury debt in the front end of the curve, it's like $10 trillion. And so it's very small. I will throw one other number out there, which is that the investment grade corporate bond market, which is, in the $15 trillion range in terms of total size, that all of that money is basically, it's money that would go into treasuries but is looking for some extra pickup. And with any risk that presents to the company level of the economy, that money floods back into treasuries and provides this buffer of demand. And that buffer of demand is several $1 trillion. And when you only have, 10 trillion and 9 trillion of it is just automatically rolling over because it's the cash pile of the rest of the world, you can see there that there isn't actually a big worry on the supply in the front end. The worry, though, Chris, is the continued growth in nominal deficits, the inability for the country to generate tax revenue that is keeping up with the spending, the expenditures. The interest rate itself being in the four handle is punitive. So every day that goes by where yields are rolling forward above 4% is an additional, it's rolling off debt that's at 2% and rolling it into 4. So the size of the coupon expenditure that the United States government has continues to go up. And then if the debt to GDP continues to go up, that's the ultimate danger, because what that means is that the debt that you're creating as a country is not going to productive enough sources. And it's only with production that the debt can be paid back. And so why I'm bullish on the United States is in large part to the capex boom. We are building things again, building things that will be able to generate production and income going forward, not just dead, empty consumer debt. But, how much is that really helping when we have $3 trillion in social safety net payments that are just going pure consumption, and it's pure deficit spending? So
Well,
having
and
to be
also,
financed.
and again, without it being, because I'm not, this is not a political statement. This is a fraud, waste, and abuse is bad statement. When you have high populated states and a majority of them have record levels of exposed corruption and fraud and misuse of the tax dollar, that's an easy place to cut in theory. But obviously, in practice, it's a political landmine that is, I mean, we still haven't seen anything real that I'm aware of in Minnesota, California, and yet it's obvious. I mean, I drive on the roads out here. You do, right? You live in LA. It's obvious we're not spending the money right, right? Like, you don't have to be a genius to figure that out. You don't have to wear a red or a blue shirt to argue that point. There's the answer there. The political will to do it is a different, the apparatus is kind of in the way. I see that as a headwind. I agree with you on the we're making things again, tailwind. I'm bullish that way. I'm not sure how it plays out in the short run. Practically, what does it mean for hard assets? Like, so people are looking for asset classes. Where do I allocate now if it's not cash? Where do I feel like I could buy a hedge against inflation, but also with a relatively low risk? Multifamily, right? Hard assets, things like that. These are all essentially predicated on the 10-year. So if the yield curve is flattening, um, where do you sit on the second order impacts to things like cap rates on commercial real estate? Because, like, I have a friend who's, Canada, he's going, "Hey, you know what? I'm gonna just buy some more multifamily because at least I know the cash flow is gonna come. The cap rates aren't great. They're 3.5, 4. That's where you want to sell it at. You don't want to buy it at that, but that's just the reality of the business today. Where do you think they go from here? And what does affordability look like?"
The on the cap rate side, it's something that I've been thinking a lot about, but I generally think that US yields are rising because growth and inflation expectations are rising. And that means that the hurdle rate has to go higher because it means that when investors are looking for opportunities, they're looking for a pickup above the risk-free rate. And so if you take out the nominal treasury yield and you just go to real yields, you see real yields at multi-decade highs today. And that's because people are essentially pricing in growth into the economy, and that there are growth opportunities out there. So risk-free yields rising can and will take capital out of the rest of the markets at the margin, and as people go into, oh, I'm attracted by this 5% risk-free rate where I wasn't at 4, but at 5 I'll buy it, so I'll sell that other asset. You're seeing that, and of course you'll see that trade-off. But I I genuinely believe that yields in general are rising because growth and inflation are rising, and that demand for compensation to pay back for future current and future inflation is just going up. And so that continues to be, I think, part of the most interesting part of the analysis is that why are stocks still doing quite well? And I know that they're off the highs a little bit, but why are they doing so well when yields keep rising? And I think it's the growth story, if we want to summarize it. And just reading Tom's note here, social safety net. Are you including social security payments to people who deposited their income into that fund their entire life? I'm not trying to critique the social safety net itself. I'm saying that the United States Medicare, social security payments, interest payments, defense payments are all adding up to a level that's way beyond the tax base itself. So it's deficit spending. I actually think that Social Security, Medicare are part of the foundations of of the country's fabric, to the point where it makes it so attractive for people to want to come here, live here, invest here, and build their lives in the United States. So it wasn't I wasn't trying to critique the United States social safety net issuing it or the people that utilize it.
Yeah, I think some of the other practical takeaways that I kind of want to get your thoughts on are just what does the demand look like for mortgage debt? And I'm going to pick specifically mortgage debt because the bond markets play into where that's priced. I'm going to give you, again, a speculative. This is a little bit qualitative, somewhat quantitative, but I'm disclosing that because I don't want anybody to take this as like Harvard did a study on it. This is Chris, you know, contextualizing a lot of things I've read in a pragmatic way. So you've got a couple forces. I think about everything through forces, right? So part of my framework. And so one of the forces that you have is you have $5 trillion a year changing hands with generational wealth for the next 22 years. That's the annualized number. That is like Cerulli and Associates did that report of money that's going from boomers to somebody else. I don't care who it is, kids, grandkids, a confiscator, a predator. It's just changing hands. So for the next 22 years, you have $5 trillion worth of wealth in today's dollars, changing hands, 124 trillion in aggregate. A lot of that wealth is tied up in two asset classes: the house and whatever's in the 401k or whatever's in the retirement fund, right? That isn't going to get gobbled up by long-term care and those kind of expenses before that person is gone. So if you really distill that down, then the illiquid part of that's probably going to be the last to go, and the thing that gets transferred is going to be the house. Now that house is not always in Florida or somewhere that the kids or the inheritor wants to live or vacation. It may be where they grew up, but it's not necessarily someone there. And it may not be in a high growth market. Who knows, right? I'm looking into that myself. But let's just assume that $5 trillion worth of houses are now going to go to a bunch of kids, 50-year-old kids like me, and who has a sister who lives on the other side of the country and who doesn't need another headache and doesn't really want an asset, but could love some cash. Or one of us has an attachment to it. No, I want to keep it in the family because it was like our Thanksgiving house or whatever it is, right? There's all those kind of things. So somebody's going to have to buy somebody else out, but they got kids going to college. They still have another parent or in-laws that they're taking care of maybe financially or that they're worried about. So at some point, as those houses start to hit the market, these are in residential neighborhoods. These are not from a developer. Wherever interest rates are kind of matters because two things. One, the motivation to sell might be more aggressive because it's kind of like free money. So they'll take the discount if they want. The market to buy is not there because people don't want to carry a mortgage at today's rates and pricing is out of whack, right? For the new home buyer. And because it's not a builder, you can't buy down the rate. So like I just had a development in Sarasota, Florida that sent me a thing where they'll buy down the rate to 4.5. If I agree to put down a deposit that I could get back, they'll guarantee me 4.5. Well, that's not too far off of the 3.5, 3% mortgage that I had before I sold my house in 22. So a builder can do that. Taylor Morrison can do that. Lennar can do that. The Gen X administrator of the family fortune can't buy down the rate. So when you think about the demand for mortgages going out 5 years, 3 years, 2 years, and where rates may or may not be, the 10-year specifically against the 2, are you worried? Are you concerned? Is there a housing bubble? Are we going up and higher from here?
I don't have a great take on the housing market, Chris. What I see and what I am observing right now is that the U.S. employment picture is robust. The amount of wealth relative to the amount of debt is also robust. The economy is growing nominally in the 7% range, which is robust. And so that's how I'm thinking of things. And when you look at nationwide housing price aggregates, they're they're doing okay. They're not doing spectacularly, but they're doing okay. So I, I I don't know. I don't have a great answer to your question about what happens to the housing market going forward, especially with this
I think
retirement
what you
boomer
did
dynamic.
though, what you did there, and I'm glad that you did it. I didn't set that up like with a leading question, but it was, I obviously was curious how you'd answer it, and you kind of answered it in a way that made me smile, which was you laid out some facts I think are not necessarily, maybe they're not even agreed with because everybody feels entitled to their own facts these days, thanks to the algos. But they're also not facts that you see a lot on the mainstream financial media, and maybe even a lot of blogs, right? Because like people don't want to think that we may have an affordability crisis. Maybe that's true, maybe that's not. But it's not necessarily broad based. We do have high gasoline prices still in certain markets, California being one of them. We do have eggs that are still a little bit more expensive than they should be and that make it harder. Airline tickets are crazy expensive for most people, right? So travel's coming down. So there are things that are real in the real economy that are problematic and that create an affordability crisis or tightness that doesn't feel good. And yet at the same time, we have 7% nominal GDP growth. We have employment growth. We have these things that you're mentioning. Arizona's a boom town with TSMC. I mean, what's happening in the West Valley over there from a development standpoint is unbelievable. So it's just not what we hear a lot about. It's fun to kind of go, yeah, America's done or we're being whatever. But it's not necessarily fact based. So we're trying to help see through those facts and figures and get a new look at it because it's harder and harder to find, I think, the center of town. Would you agree? I mean,
Yeah.
I would imagine your college students are all over the map with that, depending on
Yes.
which social feeds they're reading.
And there's also an affordability and cost of living crisis that is going on. So
Right.
that's underneath all of this good economic headline data. Actually, I said to a room the other day that the economy is booming, and people were like, "But people are struggling." I'm like, "Well, actually, cost of living crisis goes along with a booming economy because those whose wages are not going up are fighting with the wages of everyone who is making good money. So there is an affordability crisis,
Well,
which
and it's kind of like if you're a 75-year-old person living in Florida, your house is worth triple or quadruple what it was a couple of years ago, but your property taxes, which eat into your fixed income, are also higher. So you can be winning and losing at the same time. The financial economy and the real world economy are two different things and they run parallel. So these two things coexist is what you're saying. Avoiding talking about one because we're highlighting and gaslighting with the facts of another to sway a vote doesn't address the solution. The solution is somewhere in the middle of We've got to find a way to make life affordable while we boom. That's kind of what we have to do. And whoever can get that narrative right is going to win.
That's right.
So amazing. I know we've got to wrap this up. You've been awesome with your time, guys. I want to give him a big shout out and a thanks. It's been a pleasure to get to know you, Nik. More in depth, and thanks for all the live audience that tuned in. If you're listening to this on replay or live, please make sure you subscribe. If you're already subscribed to Nik, upgrade. I don't think you need more than in the last 90 minutes to decide why. I know I'm going to get his book. I didn't have his book before. I'm going to go get it, put it on my shelf. So I'm looking forward to that, all of them. But I'm actually really interested in the first one. You've got me interested in this layered balance sheet approach. I want to grok that framework and add it to my library. So I encourage everybody to do the same. I want to thank Pebble, one of our premium subscribers. They're a brand partner. I use them personally for employer of record. You can hire people in 185 countries without changing your tax nexus. I pay $3.99 a month. You'll pay less. Check them out at highpebble.ai if you have any interest in changing the compliance and the liability around your employment structure. Or if you hire remotely and you don't want the headache, they're a great solution. And that's it. Subscribe to me. If you're new to me, thank you for being here. I'd love to have you in my mix, and we'll be doing these again. We've got some big guests coming up next week. You're closing us out today. I'm doing office hours tomorrow for our paid subscribers on the generative advisor side. Nik, any final thoughts from you?
I appreciate the time, Chris. Great conversation. It's good to do this big picture thinking. The questions that you asked, each one of them, I could do a 3-hour, classroom lecture, break it down. But I really enjoyed it. People can find me at
Well, I
the
would
Bitcoin
love the
Layer.
opportunity. I would love the opportunity to collaborate somehow in the future. If there's ever any guest speaking opportunities, I would love to, contribute in any way back to your student body and to your network, because you've been very generous to my audience with this time today. So all you have to do is email me and ask, and I would love to show up and reciprocate in any way that I could.
Thank you,
Um,
Chris.
so thanks for the work, thanks for the writing, and thanks for being on the atomic level. Take care, everybody.
Thank you, guys.